Just on the mortgages point, yeah. Well, I mean, our view, I don't know if you have any comment on it, but that why can't we fix, I mean, it's a government decision, but is there any reason we can't just fix mortgage interest rates at a level that's sustainable for people, particularly when we're looking at, you know, the Peppers of this world, lashing them up to 5, 6, 7%, which is, you know, crippling people. I think the government has the power and should cap interest rates, particularly when Irish mortgage interest rates were higher than everybody else. That would be, to my mind, a good measure. But just something else I just want maybe to ask you to comment. You could comment on that, obviously, but in your quarterly report, I think it's only in your first quarterly report, you do the net household income distribution kind of thing, isn't it? Or total net household income. It's Q1 you do that. I don't think it's in this report, isn't it?
Yeah, we did publish an analysis earlier in the year.
Well, it always seems to be in the first bulletin at the beginning of the year. I never see it in the others. But
it's more a deep dive. It may just have happened in the first quarter repeatedly, but
no, it seems to be every year. But anyway, I mean, I always find that interesting because you see that year on year since about 2000, since, you know, the recession, basically, net household wealth has dramatically increased. I think at the last one I saw of your bulletins, it was over $1 trillion for the first time. That was net. Now, obviously, that will come as a huge surprise to the bottom 50 or 60% who have a tiny proportion of that, or in some cases actually owe more than they own. So it's heavily, heavily concentrated at the top. Would you say it's fair comment, because it certainly seems to me to be self-evidently the case, that inequality in the distribution of wealth is likely to have grown even further in the last couple of years? Because when we're talking about cost of living, if you have surplus money that you can invest in bank shares, for example, or in fossil fuel companies, or in property speculation, you know, not only may not have lost out as a result of the cost of living crisis, there's a very good chance you've actually seen your net wealth dramatically increase in the last 2 years. But if you owe a lot of money, or if you don't have a lot of surplus money to invest in bank shares, you've lost a huge amount. And that what we're actually seeing as a result of the cost of living and inflation crisis is a redistribution from the less well-off to the very wealthy. Is that a fair comment?
So maybe I'll start with the first one, the monetary policy impacts of distribution, if you've something to add. But maybe I'll start with your first point around the potential capping of mortgage interest relief. I would be cautious.
Mortgage interest rates.
Mortgage interest rates. Right, sorry, my fault. So a couple of things initially that strike me about that. One, I think it acts as a direct impediment to the pass-through of monetary policy. If it's a case that we have fixed-rate mortgages that doesn't variably adjust, now look, we could develop a fixed-rate market for other reasons, but that becomes the provision of the private sector financing of mortgages. If they develop in that way, we've more a US-style market where we've long-term fixed-rate mortgages. That's a different type of mortgage market, and that has impacts straight through to how they price other elements. And these are real commercial decisions that a bank has to trade off. If you have a predominantly variable rate book, you'll price differently than if you have a long-term fixed-rate book. This is a structure of market. But if we were to come along and say, for any given reason, that we insist that mortgage rates can never be above a point of X, let's say pick a random number, is it a case then of policy rates and the cost of funding for the banks was to rise above that, it wouldn't reflect that, for example? Like, that would be a real impediment to monetary policy pass-through. The second element is, I think it could, over time, leave you in a situation that it might cause anti-competitive pressures. When you think about the banking system and we're trying to introduce more and more competition, which generally drives down rates, which we've seen before the recent increase, or certainly the premium above the policy rates, introducing caps like this could have the unintended consequence of actually deterring some of that competition if they believe they have to compete in a certain way. On distribution, I know we had a couple of pieces of analysis, and what I recall from them, and others might want to join me in a moment now, is that during the actual pandemic, what we saw in terms of the likes of the Gini coefficient, this distribution of wealth and income, was actually the reverse. We saw a period where actually it became more uneven because of the supports. Now, I think monetary policy, we want to tease through a little bit with monetary policy exactly the implications, and I know there's been a lot of work in Europe on thinking about these distribution effects that Gillian might want to add on.
Sure. Yeah. Thanks. So, I mean, generally the drivers of inequality from the literature, they're largely structural rather than cyclical. So I mean, you could say, and as you've said, you know, monetary policy tightening, we've got rates increasing, so essentially there's a redistribution there from, you know, it's bad for borrowers, but it's good for savers when interest rates go up. But you know, we kind of know also that in a downturn, you know, it's like when the tide goes out, it kind of lays bare a lot of the inequalities that were structurally there already. So overall, in terms of thinking about monetary policy and the effect it has on the economy in the long term, we generally think about it from a kind of an economist perspective. We talk about the general equilibrium effect. So the best impact that monetary policy can have in terms of inequality is actually achieving its mandate. It's having price stability, having inflation at 2%, ensuring the right conditions for growth, investment, and having supply and demand back in balance. So they would be the main concerns around the kind of interrelationships between monetary policy and inequality. But it works both ways. I mean, there are also implications for monetary policy decision making in terms of inequality as well. So the relationship is both ways. And maybe just a further point on the capping of interest rates. Robert talked a little bit about the, you know, that interest rates for sure are the main tool, and anything that would cap rates would slow that pass through into the economy. It would slow that transmission of monetary policy. It would slow the reduction of inflation in Ireland. And we're back to the comment we've had before, that relativity between Ireland and the rest of Europe would become problematic. And of course, there's effects on competition and things like that as well. But more fundamentally, perhaps there's also, you know, the public authority in a way would be replacing the kind of core function of risk management, which is the function of the banking sector. So that's something we'd have to think very, very carefully about.